Hello, Sunday. What we've got here is an article by Spy in Seeking Alpha blog about quantitative easing and the Federal Reserve. The Bernanke gets on his hind legs and says what we're after here is quantitative easing driving up things like equity prices and now hopefully house prices, so everyone feels richer, goes out into the economy and spends more money. That is the plan. So Spy drags out this first chart, which is the sort of chart that the Bernanke would use himself, and the blue is Federal Reserve assets and red is the S&P. So the elbow down at the bottom left is March 2009, the low on the S&P, and as you can see it goes up and up and up basically, and the Federal Reserve assets, the balance sheet of the Fed, expands, and so causation or correlation. Certainly we've got some degree of correlation, but do we have that causation? Spy says there are other things going on. This is one of them: S&P index and earnings. The red elbow sticking down at the bottom left is the March lows again, and the S&P going up in red. Blue, earnings from these companies. Things were really bad then, but earnings were always projected to rise, and they have risen and risen as the S&P has gone up and up. Correlation again, but is it more likely that the S&P has gone up because the companies in it earnings are going up? Spy says probably. So what's happened? In the third chart, 1C, we've got US wages versus inflation CPI. We can ignore, I think, for the moment. Just take on wages. They have made their earnings go up by driving wage demands down. 2008 wage demands were coming in at 4%, and now they're coming in just over 1%. They've sacked a lot of people and driven down the wages of the people that are still working. Would that drive the S&P up? It drives earnings up and then probably drives the S&P up. More likely to be the causation. Right. Another thing that the Bernanke doesn't drag out, a chart that is probably correlation and causation, is the Federal Reserve assets, the balance sheet of the Fed going up and up and up, and PPI all commodities, the prices of commodities going up and up and up, and that looks like very tight correlation and probable causation as well. The trend is often your friend, so say these market people. So I think in this chart we've got long-term trends. Here we're going back to the Second World War, 1946 this one starts. And I think you can see that the black spotty line, it zigzags, but it zigzags from top left in the middle to the bottom. So it goes from top left to bottom in 1984, and then zigzags its way from the bottom in 1984 up now. Now that dotted line is corporation profits, yeah, in corporations. Oh, a bit chuffy this morning. So those are profits. The red line is compensation for employees, normally called employee compensation, and that started low after the Second World War, but as things were going all whoopee and good, up until 1984, the compensation was going up and up. And now I think it's quite clear from 1984 to now that compensation is going down. The question here for us to ask ourselves and try and answer is, will these cross over again? Will the profits go down and the compensation for employees go up? What I think we can certainly pencil in is that profits will go down in the future because there isn't that much buying going on. There's not that much consumption going on. Okay, so it's quite likely that the trend will start going down in the black spotty line. But the question really is, and the much harder question is, how do we get the red line to go upwards again for more labour compensation. That's the one that I certainly can't see going up. I can actually see this chart being changed round completely and both lines going down. Profits go down, and compensation for employees go down. Now, I see that possible, but it's not happened since the Second World War. One's been going up and the other's been going down. They always go in different directions. So if that's to hold, how will it be? The only other option really would be that corporate profits continue to increase. The corporations that can stay in business will make good profits, and the employee compensation will continue to be driven down. In other words, that trend has not from 1984 hasn't yet finished and will continue. And that's more likely, isn't it, than them both going bucking that complete trend and both going down. So I think we can imagine that corporate profits will go up and employee compensations will continue to go down. I'll finish with this because it's a bit lighter for a Sunday, but it's a semi-serious thing. I've touched on it this week. The Telegraph, co-UK online newspaper. Women now in charge of major financial decisions. Women have traditionally maintained tight control of their families' day-to-day household spending, but men had taken charge of major decisions on banking and financial planning, etc. However, a new study suggests this is changing, with British women now more likely to manage important issues like choosing a bank and making provisions for future savings and spending, etc. I've popped this in because two things. The women coming into the workplace are cheaper and are often more educated than their male counterparts. One day, women will be more in charge of things because it'll be impossible for the dim men to keep them down. Would it be possible that women will change this trend somehow and move to a more equitable future where corporate profits start going down again and labour compensation goes up again? It's only an idea. It's only an idea. It's Sunday. Leave it with you. Bye.